Hello, and welcome to Wealth Management Insights. I'm Monica Guerra, Head of U.S. Policy for Morgan Stanley Wealth Management.
And I'm Daniel Kohen, U.S. Policy Strategist in the Global Investment Office.
We're recording this audiocast on Monday, February 23rd from Washington, D.C. And today we're breaking down the recent Supreme Court decision on Trump's tariffs. So Daniel, let's start by setting the stage here with really what happened.
Thanks, Monica. So on Friday, the Supreme Court struck down President Trump's authority to impose tariffs under the International Emergency Economic Powers Act, also known as IEEPA. That levied a 10% universal tariff on our trade partners. The decision is consistent with what we've expected since May 2025. So what happens now, Monica?
Well, even though tariffs under IEEPA are no longer valid, in short, we expect tariffs are here to stay, as the administration still has other ways to impose them. For example, shortly after the decision, the president imposed what is estimated to be a 10 to 15% global tariff under Section 122, which can last up to 150 days, effectively replacing the IEEPA framework for now. Importantly, Congress would need to approve Section 122 tariffs after the 150 days, which we don't view as likely. However, the administration is expanding product-specific Section 232 tariffs and additional Section 301 tariffs. So the Supreme Court ruling changes the tool, but it doesn't remove tariffs as a key economic and fiscal policy lever under President Trump.
Absolutely. And at the same time, the president has already been exempting a number of everyday agriculture, industrial, and consumer products in the last few months. If the new tariffs you mentioned are introduced, there may be carve-outs again, especially for consumer items that have seen relatively higher effective tariff rates. That kind of exemption approach could support faster goods disinflation and could be more supportive of consumer-exposed stocks.
That's right. And while consumer-exposed stocks are positioned to benefit from the decision, and we saw initial enthusiasm across markets when stocks rallied on the ruling and Treasury yields spiked, market performance ultimately pulled back after the administration announced the new tariff regime and investors digested the implications of the tariff replacement plan. In addition, the Supreme Court decision did not address the path for tariff refunds, which means it could end up being decided through lower courts and take a much longer time. And that matters for the deficit because the ruling invalidates over $130 billion in IEEPA tariff revenue collected under Trump. It also calls into question roughly $300 billion a year in future tariff revenue. Even if new tariffs get imposed through other authorities, the overall bias, in our view, is towards higher, longer-term bond yields due to a growing government deficit and potentially more debt issuance.
And another question we've been getting on this topic is what happens to the president's existing trade deals? Well, bottom line, the removal of IEEPA does not automatically alter the trade deals, including with the UK, the EU, Japan, South Korea. But it could reduce some of the leverage the administration has in using tariffs as a foreign policy tool. So negotiations may still continue, and countries are signaling that actually more clarity is now needed in light of the new tariffs.
That's a really great point. And we'll be watching any action the administration takes to replace the IEEPA tariffs, what the refund process may look like, and whether there are any developments to future trade deals. As always, thank you for listening. For a more in-depth discussion at the intersection of policy, markets, and the economy, please ask your Morgan Stanley financial advisor for copies of our most recent U.S. Policy Pulse report.